This podcast on investor perspectives on retail and the consumer is brought to you by the Omni Talk Retail Podcast Network. Ranked in the top 10% of all podcasts globally and currently ranked in the top 100 of all business podcasts on Apple Podcasts, the Omni Talk Retail Podcast Network is the network that we hope makes you feel a little smarter, but most importantly, a little happier each week too. And today's podcast is just one of the many great podcasts you can find from us here at Omni Talk Retail alongside our Retail Daily Minute, which brings you a curated selection of the most important retail headlines every morning, and our signature podcast, the Retail Fast Five, that breaks down each week the top 5 headlines making waves in the world of omnichannel retailing. And that comes your way every Wednesday afternoon. Hello, everyone. I'm one of your co-hosts for today's interview, Chris Walton.
And I'm Ann Mazinga.
And we are bringing back one of our favorite guests and people, Karl Bracken, the CEO and founder of Ocampo Capital. Karl is here to discuss what it takes to close an investment round, to share his perspective on all the turmoil happening in the market, and if we play our cards right, and hopefully we can even get him to talk about some of the investments on which he is particularly keen. So, Karl, without further ado, thank you for joining us and welcome back to Omni Talk.
Thanks as always for having me, guys. It's always awesome to be here with you.
Well, Karl, we have interviewed you before and know you well, as Chris mentioned in the intro, but if you wouldn't mind just giving a quick background on you and what Ocampo Capital specializes in from a VC standpoint.
Yeah, for sure. My background is I actually started my career in finance at JP Morgan. I worked in the venture capital group in San Francisco during the dot-com bubble, and pretty quickly realized like I needed to get some operating experience if I was going to be legitimate doing that. I was definitely not then. So I went back and got my MBA at Kellogg. I was in the same class with the incoming CEO for Target, Michael Fidelki.
No way.
We were classmates, and started as interns at Target on the same day in June 23rd, 2003.
Wow, you remember the date. That's great.
I do. So came to Target after my MBA and was there from 2003 till 2019. I started my career in merchandising where I met you guys and was in merchandising for about 8 years. And then from there, went and led the inventory management function and then led the supply chain transformation. And then after that, I left Target. I became CEO of a beauty manufacturer for a short period of time. And then I was chief merchant and chief supply chain officer at Guitar Center for about 3.5 years. Kind of in the meantime, while I was, kind of going through my career, something just kept hitting me. And particularly in my days at Target, which you guys will appreciate, is there were all these, young companies would come in with great product ideas, and they would come into Target. They would sell their ideas to Target. Target would like them, and Target would award the business and give them a purchase order. And what would happen is these companies would leave high-fiving, and then they'd come back a couple months later and say, we can't fill the purchase order. And the reason they couldn't, generally speaking, was either because they didn't have the funds to make the inventory, or they couldn't operate at scale and grow that fast. And so what would generally happen is Target would pull the purchase order and the company would be left to go bankrupt or kind of go away. And so it kind of struck me, and I just kept thinking this over and over again at Target, which was, what if this company had somebody investing in it and someone to help them operate? Like, couldn't have ended better. Like, they had the product, And so about 6 or 7 years ago, I started investing, just angel investments in companies with this as kind of my idea, and helped them operationally. And the idea was hopefully they would grow. And so it was working pretty well. So I decided about 2 years ago to found Ocampo Capital, and announced that I was going to launch my first fund about 1.5 years ago, and closed my first fund about 6 months ago, a little less than 6 months ago. So that's it. What do we specialize in? We're early stage consumer investors. So I invest in businesses in repeat purchase categories. So think like beauty, personal care, health and wellness, baby, pet, food and beverage, things like that. Invest in them and help them try to grow faster.
Wow.
Wow. So I mean, true entrepreneurial story, and jumped feet
Mhm.
first into VC after dabbling it as an angel investor and having years and years of experience on the operator side too.
It was scary. Yeah. I mean, I'm happy to talk about what it was like, raising a fund. It was not for the faint of heart, that's for sure.
Well, that's actually what I was going to ask you next, Carl. I'm curious, like what. So first of all, I mean, I think Ann and I have to give you huge congrats on closing a fund like
Yeah.
that. In and of itself is not easy. And I want you to explain why that's not easy, and also what does that process even look like from start to finish? Because Ann and I have never really been through that on either side of things.
Yeah. Well, the process began with me waking up one morning at like 3 in the morning and being like, well, I've always wanted to do this. What is keeping me from doing it? And realizing what was keeping me from doing it was fear of failure and going out, to say I was going to raise a fund. And so literally what I did was that morning I got up, I'm like, this is stupid. This is like, if I'm going to do this, now is the time for me to do this. And so I literally called up a web designer and had them build my website. And then I announced on LinkedIn that I was doing this as a way to keep myself from like chickening out. Um, and so that was it. So I announced
Good
that.
mechanism. Good mechanism.
Yeah. And so I announced it. Now, what I would say is, the reason why it's so hard to raise a venture fund, and particularly a first one, is, your investors are betting their hard-earned money on you personally. You don't have a track record. You don't have, anything other than that. And so, the people that invested in my fund, thankfully believed that I could, help get them good returns by finding good companies and investing in them. And so that was kind of the start of it. It's really hard going out and pitching, your idea to potential investors and having them, 9 times out of 10 or 5 times out of 10 or whatever it be, maybe like giving you a thumbs down. So that was the the fundraising part. The way fundraising works in a venture investment is, you have a series of closes. So you'll raise a certain amount of money, and then you'll have your first close, and then raise some more money, have a second close. That whole process for me was about 15 months or so, and then you have a final close. And after you have your final close, that means your fund is locked in, and everyone knows what percent of the fund they account for, and what percent of the companies that you invest in they will account for. So yeah, I mean, it's just a lot of pounding the pavement and kind of hopefully getting people to agree with your vision. So yeah, that was it.
Carl, I'm curious, like one of my favorite expressions personally is experience isn't something you have until after you need it. So having gone through that 15 months, what is something that you look back on now and you're like, man, I wish I knew that the first time, and I'm going to leverage that the second time around?
That's a good question. I would say, one of the things is, I'm constantly learning and refining my investment thesis. And so there's certain things about my investment thesis early on, that I think were approximately okay, but are like much more defined now. And so, so that's the first piece. I would say the second piece is knowing where your sphere of competency ends, and knowing how to surround yourself with people that can, and service providers that can fill the gaps. So I went into this thinking like, I'm going to do the whole thing myself. I'm going to do the accounting myself. I'm going to do, and in retrospect, that was insane. And so, I had a neighbor when I lived in Minneapolis across the street, and he would see me, mowing my lawn and like trying to fix things in the eaves of my house and stuff. And he would always shout across the street, outsource all non-core functions. And, and I would say that is totally true as I think about, my experience here. Like, I have a fund administrator. They are managing how, all the documentation and everything gets to my investors. Like, I should not be doing that. My accountant, I should not be doing the accounting, things like that. And that's made it a lot more efficient, so I can focus on the things where hopefully I can add the most value.
Well, Karl, I'm curious what the landscape looks like right now. What it seems like the investor climate is a little challenged. Are there a lot of companies that are closing funds? You did that in 15 months. That's pretty impressive. But how would you kind of sum up a state of the market right now?
Yeah, I would say there's two pieces to this. There is, if you're an AI business, and then there's if you're everything else. So if you're an AI business, it's like it's go,
Yeah.
Y2K all over again. I would argue that it's in a pretty big bubble. But that's getting in funded right now. If you're an AI business, is not that hard. No wonder so many companies that are, serving burgers are putting AI on the end of their company, so they can get a higher
Burger AI. That's a great one.
Yeah.
Yeah.
Yeah. We interviewed somebody and he was like, you could be bread AI right now and somebody would give you money at this point in
That's
time.
right. That's right. They said that. Yeah.
It is true. Yeah. I mean, maybe you guys should think about, Omni Talk .ai or something. I don't know. But
believe me, it's been discussed, Karl. It's been discussed.
So that's one side of it. And that's actually about 40+% of venture dollars are going to AI companies right now. And it's I would say pretty bubblicious. On the other hand is everything else. And when you look at everything else, it is a challenging funding environment. And in consumer, it's about as challenging as it is in any possible area. Now, why is this? There's a couple reasons for this. So first is any legacy venture fund that has raised funds is trying to raise another fund now, and they're having a very hard time doing it because of the IPO market. There have been so few companies going public that they aren't having any liquidity events, and because of that, they can't return money to their investors. And so that has made it really, really hard for any venture fund to fundraise. The second thing I would say is there were a bunch of kind of generalist venture capital firms that had invested in consumer a number of years ago. So think of like Amazon aggregators. There was a big push to invest in that, or influencer-led brands, those kinds of things. And a lot of those guys got burned pretty badly on their investments. And so that's caused some of the venture investors to just kind of walk away from consumer entirely. And then, like I said, there's so much money going to AI that it's like crowding out investment in other categories. So, with all that said, it's a very challenging time to fundraise as a venture fund because so few venture funds are able to raise. And because of that, it's also very hard to fundraise if you're a company looking to fundraise. If you're, there were 30,000 consumer brands founded last year. Many, if not most of them, are looking for some sort of venture capital or some sort of investment, and they can't get it because there's so few companies investing. So the consumer venture dollars are down in total down almost 90% from where they were 3 years ago. So it's down. Yeah, it's down pretty dramatically. And
well, Karl, just a quick question. Like, what does that mean then for these consumer brands? Is it looking at like shutting down like it was when the whole reason behind why you started your fund? Like, what does that mean for the landscape then?
Yeah, it means for a lot of them, they have to really refine their business model and make sure that it is on point and efficient as a business model. And that's a big piece. Run lean, go slow to go fast, that kind of thing. I mean, and I preach that to every company in my portfolio too, is, it's go slow to go fast is a good way to be operating in any environment, particularly now. But, on the positive side, if you look back on some of the biggest consumer brands there are in the world, there's a huge percentage of them that were founded during major economic downturns and very tight funding environments. And I think one of the major reasons why is because they had to have a really awesome business model. And so if you can make it through the lean years, you're going to be just propelled forward faster in the big years. So think about like Coca-Cola, Procter and Gamble, Microsoft. Like there's so many companies you could call out as companies that were founded during pretty tough economic environments. So that's that. I mean, just one last point I'll make here is just to give you a sense for how tough it was. My small fund actually accounts for 6% of all U.S. consumer venture capital dollars raised by first-time investors in the United States this year.
What?
Yeah.
Jesus.
Yeah, that's how tight it is. So,
and congrats again, my friend.
Yes,
wow, that's a pretty awesome statistic drop too.
Well, I'll say.
Wow.
it's a good stat, but I think it says more about how tough the environment is and less about
Right.
how huge my fund is. So anyway.
Right. Yeah. Well, then it also it tells you, what potentially, which we'll talk about more, gives some insight into your investment thesis and why people are interested in you too. All right. So let's shift gears a little bit. We want to have a little fun here with you.
Okay.
I'm going to do something Ann and we've tried it a couple times with different folks. We're going to try it with you. So one of the things I always think about when running an investment fund, and honestly, it is probably the number one reason I personally would never do it, is that you have to handle other people's money. And so I can imagine, I can imagine you are fielding all types of calls from people about all sorts of topics. So Ann and I are going to pretend that we are each one of your investors and ask you what is on our minds. Are you ready to play this game?
All right, bring it on. Hopefully I've heard these before.
I imagine you have. I imagine you have, because when it's about people's money, they get really serious really quickly. So,
They sure
all right,
do.
first one, the topic du jour, tariffs. What's my exposure on tariffs, Karl, if I'm investing in your fund?
Yeah. So we went through a really detailed analysis of where we might have tariff exposure earlier this spring. And thankfully, since almost all of our businesses are produced in the United States, our tariff exposure is actually pretty limited. We have some packaging exposure, packaging being made in China that for our products, like there's a little bit of exposure there. We have a couple products that are manufactured overseas. And those products, we have tried to move the manufacturing location. And in most cases, that's been like pretty effective. But at this point, I would say our exposure is relatively limited. Now, if we had been investing in businesses like long lead time apparel that's produced overseas, or other consumer categories that I don't know, sporting goods or things like that that are largely made overseas, that would be a much scarier proposition. Thankfully, we don't have much of that in our portfolio.
Okay, what about AI? Everybody's talking about it. How carried away with it should we get?
Yeah. Okay. So I think it depends on what you mean by that. So if you're talking about direct investments in AI companies, I kind of alluded to before, I'm haunted by my experience working in venture capital in San Francisco during the dot-com bubble.
Yeah.
It was, back then every company was changing their name to look like an e-commerce company, even if they weren't. And the reason why they were doing that was because the valuations were higher, and it was kind of a popularity contest. But I would say in 2001, 2000, 2002, that time frame, everyone knew e-commerce was going to be big. What they didn't know was who the winners and the losers were going to be. Think about it. Like Amazon.com was a book seller. Did they have any right to win more than Pets.com did? At that time, on the surface,
Great
maybe
point.
not. And so that was, so because of that, really, no one knew who the winners and the losers were going to be. I would say the same thing with AI now. Like, I am not an expert on AI, and that's actually the main reason why I don't invest in it, because I don't have a right to win. But just as an outsider looking in at it, to me, I think that the biggest challenge with AI is you don't know who the winners or losers are going to be. Like, everyone knows AI is going to be a big thing. There's no question about it. But, I don't know if XAI or Anthropic or, whatever, OpenAI or whatever is going to be the winner, or something that hasn't even happened yet. I mean, if you think about how fast it's iterating, and you're thinking about a long-term investment cycle like a venture investment, how do you know which LLM model is going to be the best at version 15 versus version 3? I mean, I have no idea. So I have no right to win in this space. I know very little about it. So from the standpoint of investing, I stay away from it. Now, on the other hand, when you think about the impact that AI companies can have on your portfolio, like, that's pretty important to know. Because you are holding these companies for a long period of time, and I don't know how AI is going to continue to evolve, but I do have a feeling that 10 years from now, consumer products are still going to be purchased by people, and so where AI can help you, that's really good to know. Where AI could potentially disrupt you, that's also good to know. And so I try to stay away from categories where I think AI can quickly disrupt the businesses, but stay very close in where AI can help either my fund or the businesses propel faster. So AI is a huge topic. Hopefully that answers your question.
Karl, what's an example of a consumer business that could be disrupted by AI in the space that you're generally treading within?
Yeah. Let's see here. I'll mention a couple of areas. Like one
Okay.
would be like consumer businesses that are based on some sort of a technology infrastructure or tie into some sort of a technology that could be disrupted. I think about like electronics products or something that are like IoT products that could be a challenge. Or you think about like products that are based on a like biotech underlying sort of research that could be disrupted by new research that's better. Those are the types of things that I think are potentially disrupting. Yeah, things like that.
Got it. Got it. All right. So next one. So man, Karl, I'm just really fretting about this consumer. You know, the consumer confidence continues to seem like it's on the decline. It seems like it's declining every single week. What's the outlook on that? Like, how concerned should I be about the state of the consumer right now in my investments?
Yeah. So there's two answers that I would give you to this. So the first one is, the short-term answer, and then the second one's a long-term answer. The short-term answer I would say is not as relevant for what I'm doing, because if we're in a technical recession today or a technical recession, in the next 3 months or whatever, that's not really going to impact what I think the outlook is 7 to 10 years from now for my companies I've invested in. But on the other hand, when you think about short-term trends, like, do I think the consumer potentially is under some stress? Yes, I think consumer is kind of bifurcated between the high upper end, the higher income and lower income consumer. You see credit card balances increasing and revolving credit card debt increasing. That didn't end well in 2008. That's a little scary. So there are some indicators that the consumer is not as strong as they were, but they do tend to, they seem like they're still spending. I think it's just who's winning and who's losing. I mean, look at Walmart. Walmart is reported good earnings. So there's there's consumers that are still spending. I think it's shifting around. But for me, longer term, it's about what is the state of the broader macro environment 7 to 10 years from now. And I can't really get too caught up in the short-term consumer interaction, because that may or may not be, correlated with what I think is going to happen with my companies.
Well, Karl, what should we be betting on then? I think that's especially interesting to me as you're talking about, health and beauty and wellness and pets and, consumer products like that we're using day in and day out. What's going to change about that, or what would you be placing your bets on?
Yeah, that's an awesome question. And what I would tell you is, it was back to your earlier question about, things that I learned over the course of doing this. One of the biggest ahas I had was like the way to translate a merchant mindset as a former merchant, and the timelines that you think about there to the timelines you think about as a venture investor. And so, as a merchant, as you guys know, you're thinking like 1 to 2 years out. You're thinking like, what can I bring into my assortment that'll do well over the next 12-month cycle, or 2 years. As a venture investor, if you think that way, you're thinking too short term. You need to be thinking like much longer, and you need to be thinking about what are trends that are going to last for the next decade or 2 decades or 3 decades. And so when I think about that, you think about what's changing more macro in the world. You think about what are new generations caring about? What are they interested in? And so when I think about some of the consequences of that in some of the areas that I'm investing in, it's things like, consumers are taking health into their own hands a lot more than they were before. Now, why are they doing this? I think there's several reasons. One is it's hard to get a doctor appointment. Secondly, is they may or may not trust doctors or trust the established medical community as much as they used to. Third is it's gotten super expensive, to participate in the medical field in any way, shape, or form. And then fourth is they have a device in their hands that make them feel smart about how they should be taking their health into their own hands. Right, wrong, or indifferent, that's happening. And so,
Mhm.
underneath, so that is a trend, and that's a trend that will continue. I mean, I'm confident that's going to be a trend for the next decade or 2 decades. I don't see, all of a sudden, there being big, decreases in healthcare costs or things like that. And so, because of that, I'm looking at things underneath there, such as like gut health, women's health. I think the gut microbiome is something that is here to stay and will be for a long time. Women's health, other areas that are health related products that they could benefit people outside of their doctor appointments. So that's one area. Other areas I'm looking at things like antiquated models. Like think of consumer products that have been around for a long, long time, have not been improved upon or revised upon in like decades or even a century. Those are areas that are ripe for invention. And so that's one area to look. And if you see something that's been iterated on a million times over the past 3 years, there may be less to squeeze out there. But in some of these other categories, there could be more. The third area is the environment. I think that the environment is for younger generations particularly, but for everyone, is becoming a bigger and bigger determinant of what they're buying. And so that's something that I think about. And then fourth one is pet as humans. So
Huh.
treating your kids like the same way you treat your pets, or treat your pets even better than your kids. Like that is a trend, and I think that's going to continue too. You look at how long that trend's been or that pendulum has been swinging. It's like the past 50 years. So will that continue? I think it probably will for the next 10 to 20. So anyway, those are just a few examples, but those are the kinds of areas I look at.
My wife would definitely agree with that last one in terms of the pendulum continuing to swing in that direction. All right, well, Carl, I'm going to
Yeah.
put your feet to the fire here then, as we start to close things up. But
Yeah.
let's put your money where your mouth is. Let's put your feet to the fire.
Right.
What are some of the companies you've actually bet on?
Okay. Well, maybe I should just break it down by the same sort of like categories I just shared with you.
Yeah.
So if you start with like taking health into your own hands, um, I have several companies in the portfolio that were founded by PhD chemists and PhD biologists, and have patents on research they've been doing that are now bringing products to market. So, for instance, there's a company called ZBiotics that we've invested in. ZBiotics was founded by a PhD in microbiology and immunology, and they have created the first genetically engineered probiotics to solve certain like states that you're in. So it's deep tech being applied to new categories. So, for instance, their first product cures hangovers. It breaks down the byproduct of alcohol that causes hangovers. Their second product is it actually takes sucrose in your stomach and converts it to leaven fiber. So imagine what that does. You no longer have spikes in glucose if you're wearing a CGM, continuous glucose monitor. It basically flatlines your glucose. So that's one company that is
Wow.
really interesting. Second company is Persephone Biosciences. They're coming out with their first product actually on September 9th. And what they are is they were founded by two chemists, one from Caltech, one from Berkeley. And they have been studying the gut microbiome, like I mentioned, for the past 8 years. And originally, we're going to be launching like an oncology drug, and they're still going down that path. But they've realized that same platform can be used for consumer products. So their first consumer product is actually a powder you can add to baby formula, and it'll actually revert a baby's gut microbiome to what it should have been at childbirth. So if you think about it, 90% of babies are born with compromised gut microbiomes, and the reasons why are there's several. One is being born via C-section. Another one is mom taking antibiotics before childbirth. So things like that. And so their research, the research has been published in peer-reviewed journals, but their research actually shows that is the case, and their product actually solves it. And so think about that'll reduce the likelihood of babies getting like food allergies or eczema or some other thing. So anyway, so that's really compelling. That's coming out on September 9th. A third company is Volley Wellness. So that's a functional beverage brand which tastes better, is derived from clean superfood ingredients, helps athletes, with hydration, energy, that kind of stuff. Really, it's a very competitive space, but their products are amazing, and they have differentiated ingredients in their products. So that's on that first sort of like, science level set of products. The second one is, kind of improving upon this like antiquated model thing, is we have a company called Zaya, which actually is launched in Target. And what that does is it's a air diffuser that is aromatherapeutic and actually good for the environment. It doesn't use heat, and it doesn't emit toxins. It actually is better for you. And it's a diffuser system that you buy, and it'll help make you feel better. So that's the second one. Yeah. Third, the environment. I have a couple companies under there. I'm just rattling things off. Is this okay?
Yeah, no, keep going.
This is amazing.
I'm loving this. It's cool to hear about new companies. Yeah, this is great. Keep going, man. You're on a roll.
I'll keep rocking then. Just tell me to shut up whenever you want.
No.
Is, like the environment. So companies that are kind of tied into the environment. So one is a shampoo and conditioner company. The shampoo and conditioner is actually powder. And
you told us about this one. I love this company.
Yeah,
I've been obsessed since you told us last time, Karl.
Yeah, they're starting to scale now. They're in salons, and they're getting into retail. Yeah, so rub it under powder that's salon grade. You rub it under water, it reconstitutes into shampoo and conditioner. And so they just won their second Marie Claire award. So they're doing really well.
What's it called again, Karl? I don't know if you said it before. Just
make sure Small Wonder.
Small Wonder. Okay.
Yeah. Another company is Shameless Pets. I think I may have mentioned this one to you guys before too. But that's basically, it's a pet treat company that's made with upcycled ingredients. So ingredients that would otherwise be food waste getting reconstituted as food. So it's better for the environment, and they've saved millions of pounds of food that would otherwise be waste. They're off to the races. That company is doing really, really well. And another one is that I would say is sort of kind of the last company I'd mentioned is Cohere Commerce. And what they are is they are a platform that can actually that interfaces with early adopter grocery stores, and they can take the companies that they're putting on their shelves in these early adopter grocery stores, and they can with pretty high certainty tell which of the brands are likely to scale fastest in retail. So imagine if you're a merchant, like how much would you have liked to know that when you're thinking about your next planogram revision or transition? And for me, I've actually invested in another company in my portfolio, Cocada, which is a better for you snacking brand, because of the information that I got from the Cohere Commerce platform. So it's been that's pretty awesome too, as far as like, sort of the intel inside of what's happening in early stage grocery. So yeah. So
Karl,
anyway, that's it.
Well, that last one's a little bit of a different flavor than the other ones that you mentioned. So what gave you the confidence to go in that direction? Because that's more of a tech play. What gave you the confidence to go in that direction on that relative to where it seems like you're spending more of your investment time?
Yeah. So having been a merchant myself in food and beverage at Target, I had a pretty good sense for basically which questions to ask there and how to help them. Like this is one where I'm able to help them a lot with sort of their ability to scale because of my background, and particularly like what's on their roadmap. Also, that's one where the information is so valuable and so obvious for for merchandising teams or for investors. My thought was like I could help them propel forward because I know the categories well that they're getting into, even though the underlying technology, I have to trust them on that. So yeah, there are two data scientists that founded that company. One was he actually was a Michelin 2-star chef, and then taught himself data science and ended up being the founder of Wynn Casino and Resorts data science team. So he ran all the data science for Wynn casinos. Yeah. I mean, obviously, incredibly smart. So
what a renaissance
after becoming
person.
a 2-star chef too.
Yeah. Exactly. Yeah. Pretty amazing.
Well, Karl, I don't want to end this conversation because I feel like every time we ask you a question, I get deeper and deeper into this. But in the interest of time,
Yeah.
let's get you out of here on this question. The VC game, it's a long game.
Yeah.
You have to be a long-term, you have to have a long-term investment horizon to be successful. So what would you say is next? What aren't we talking about that maybe we should be?
Yeah, I would say what's next. What's next for me is helping these companies grow fast. Like the companies I've invested in, how do I help them as best as I can be successful? And that's something that hopefully is a differentiator for how I operate my fund. So that's the first thing that's next for me. Continuing to look at emerging companies and continuing to look at emerging, sort of trends as things for me to consider investing in. And we're about 50% invested in the fund, so I still have quite a ways to go. And so definitely open to reassessing and constantly learning about what's new out there. I will say this, like I mentioned early on, I don't really care that much about short-term fads. I care a lot more about things that will continue forward as trends for a long period of time. And so that is something I think about. But just like you guys, I want to be kind of a constant learner, and so definitely open to seeing different businesses and seeing ways that I could maybe help them. So that's what's going.
Karl, yeah, Karl, how much do the people and their personalities or pedigree come into play there? Because I have to imagine, like, when you're thinking long term, it's not necessarily about like what the product is today, but where it could go, and maybe the team's ability to iterate or be more agile as times are changing. How do you kind of set up like a rubric for that, and how much does that weigh into some of your decisions when you're thinking about investment?
I would tell you that the most important thing I look at is the founding team, the leadership team. And that has gotten, since our last time speaking, that's actually become a bigger focus for me. And sort of the epiphany for me on that is if you have a like an A+ business plan with a B- leadership team, every young business is going to have to pivot. It's like, it is a requirement. Like there's no such thing as a young business that doesn't have to pivot. And so you may have what seems like an A+ business model, but it's going to have to pivot, and it will not be an A+ business model. So if you have like a mediocre leadership team, they're not going to know how to pivot to make the business as successful as they can. Now, on the other hand, if you have a B+ business model, but like an off the charts awesome A+ team, that A+ team will find ways to iterate and iterate and iterate to make that business as good as they possibly can. And so the leadership team matters a ton. And so I, honestly, while I mentioned a couple companies that had really strong pedigrees, the actual educational pedigree and stuff like that, I don't focus on that as much. I focus more on experiences they've had and skill sets that they have that would make them likely to be successful. If they have a great academic background too, all the better. But it's less like, do you check the boxes on my list of things as a leader, and more about like what is their intuition? How do they think about problem solving? And that you can only get that through lots of interaction with them and lots of conversations to as part of the due diligence process. But yeah, it's a big part of it for sure.
Awesome.
Karl, how important is assessing frugality in as you're evaluating these? I mean, is it? Yeah, I'm curious. Like, what's your take on that?
That's one of the hardest things to assess. But that's
I would
also
think
one.
So.
Yeah, it's also one of the things that can make or break a company, and it's one of the things that I can hopefully help them with. But yes, I would always side on a business that is making frugal, smart investments. You're never going to be able to save your way to success with a young business at all. But you are, that said, you can absolutely succeed. If you're making like smart small bets and not spending money as fast as you're bringing it in from investors. So that is just super crucial. So yeah, I mean, that is one where it's like you partly know as you're investing in these companies. They don't have much of a track record, so it's a little hard to tell. But it's taking the track record that you can see and asking them the right questions, and then doing everything you can to help them kind of get to that point. Because frugality can be learned too. It isn't like you're born either frugal or not frugal. So
right,
yeah, so it's a lot of that.
Yeah, you need to know what steps to take, right?
Yeah, exactly.
Cherry said something similar. She said she looks very hard at the income when she was on the program last. She said she looks very hard at the income statement to see like what are the signs of frugality being shown by the way the business is actually moving to? I imagine you're looking at that as well.
Yeah, I mean, I look at cash burn a lot, and cash burn is a sign of frugality or not. Yeah, and so and where are they? Where's the cash being spent? If it's being spent,
what's driving the burn?
Yeah, exactly. That's really, really important. So you look at that, and you can get a reasonable sense of are they investing in the right places? Are they trying to conserve cash in areas where and one CFO once told me, like, save money where it doesn't matter. And like, that's right. Like, if they're spending money on stuff that doesn't matter, like, big Christmas party, big holiday parties, whatever, like, not smart. There's no positive, ROI on that.
Right,
So,
right.
Yeah.
No fun. No, just kidding.
Not
right.
that.
All right, man. Well, Karl, thanks for being with us. This is awesome. We just absolutely love talking to you. It's so great to get your perspective on everything. And again, congrats on closing the fund. For everyone out there listening, what's the best way for them to get in touch with you if they want to, for all kinds of reasons, I guess, based on the conversation we had in this podcast? What's the best way for them to do that?
Yeah, I'm on LinkedIn. Feel free to reach me there. And then also info@ocampocapital.com. They can reach me through that email handle. And yeah, I'm not a huge social media guy, but those are two good ways to get a hold of me for sure.
You do it just enough to be dangerous, though. You do it just enough to be dangerous. All right, well, that wraps us up. Thanks again to Karl Bracken, founder and CEO of the new venture capital firm, Ocampo Capital, although it's not so new anymore, really. Thanks to him for sitting down with us today. And thanks to everyone out there for listening to this next episode of our ongoing series on VC perspectives across retail and the consumer goods industry. Please let us know what you thought of our interview with Karl on social media. And as always, on behalf of all of us here at Omni Talk, be careful out there.